It works? It's on? It's on now? It's fine? Thank you. Apologies for the delay. The colleagues there had some technical challenge there with getting the live link working. So we will commence now. In the interest of time, let me just apologize to the panelists and to the audience who are here for the late start. My name is Leslie Maasdorp, and I'm Vice President and Chief Financial Officer of the New Development Bank. Very pleased to have with us here senior leaders from the development finance community to talk about one of the most critical topics at this COP and the last few COPs since, probably since Paris, actually, on private capital mobilization. It is a topic that have featured prominently already at this COP. So we hope to draw on the insights from the people present here, and we will specifically try and prompt them to, or provoke them to come with specifically what their institutions are doing so they can share some fresh insights into this topic that is already now being debated for several years. And the topic really is about how do we scale the initiatives of the MDBs so that we can more effectively raise much larger volumes of development finance into the climate arena. Let me quickly introduce the panelists and then make some brief opening remarks, after which I will pose some questions individually to each one of them. I'll start with Boitumelo Mosako here, who is the CEO of the Development Bank of Southern Africa, one of the leading financial institutions on the African continent in development finance. Dr. Erik Berglof, who is the Chief Economist of AIIB, the Asia Infrastructure Investment Bank. And then we have Sean Kidney, the CEO of CBI, the Climate Bond Initiative, one of the leading global advocacy groups, and one of the leading advocates himself, Sean, in terms of the global climate movement and the climate agenda. And then finally, Sanjeev Gupta from the Africa Finance Corporation. Let me make a couple of brief introductory remarks. I think the debate, probably in earnest, started in 2015. In 2015, the Addis Action Agenda, it was called, the idea of private capital mobilization in its current form was sort of born there. I think it's fair to say that over the last 8 years, there's been incremental, slow but real progress in MDBs shifting gears towards, or rather away from, their traditional model, which has been about deploying their own capital, doing projects, sustainable infrastructure and sustainable development projects, leveraging off their own capital. And the business model has pretty much remained intact since then. I mean, I would argue that today we probably have the most enabling environment for significant change in the private capital mobilization agenda, because there's been consensus that have been reached within the MDB community, driven by the G20 over several reports over the last number of years. The first one was a series of initiatives that emanated around 2016, 2017, directing MDBs to look at balance sheet optimization. That was followed by another major report looking at the whole system of MDBs and what are the systemic barriers for the institutions to become more effective. That was captured in the EPG report, which Erik and others here were quite involved in drafting. That was released at the Bali annual meeting in 2018. And then the very important CAF report that was released also by the G20 focused on what MDBs could do as institutions to become more effective in raising and utilizing their capital better, including drawing on the callable capital and so on. And then finally, this year, the G20 came up with a new report, MDB Reform Agenda, which also hopefully put to bed all of the systemic barriers or the institutional barriers, the things that are under our control that has now been set out. So in short, what I'm suggesting is that there's now a much higher degree of consensus of what we can do as institutions to become more efficient and more effective. one of the barriers actually for private capital mobilization is that our institutions have become very slow moving. We are perceived to be bureaucratic and so on. So the institutional investors also have great difficulty. They see a hassle factor dealing with our institutions because each one of us have our own procedures, our own development impact metrics, our own loan pricing regimes, our own ESG standards, and so on. We now have, I would argue, within the MDB community, an agenda, a roadmap, which has been defined by the G20. So I guess what I'm saying in short as a starting point is that I'm arguing that from a systemic level, the industry or the development finance community is very committed to implement a whole series of steps, and we won't go into the detail, which will create a more enabling environment for private capital mobilization. Our session here today is to look at what are those remaining barriers and what are your institutions doing to crowd in more private sector capital. With those brief remarks, and let me just also make one final point, which is around MDBs working as a system. We heard from Ejibanga in a number of interventions he has made over the last 2 days. The World Bank is taking this agenda very seriously. They are playing a leadership role in bringing MDBs together around a set of standards which will now be sort of harmonized. MDBs will work together much more closely going into the future. And the leader of the new heads of MDBs, Goldfein from the Inter-American Development Bank, also emphasized this morning that they have placed this at the center of their agenda. So I'm going to now move over to the Q&A session with the panelists, and I'm going to start with Boitumelo. And as I said, we know what the common issues are around private capital mobilization. What we're hoping to also draw out from you is what new insights you've picked up in your conversations here the last few days. But specifically, we want to know what are your institutions doing in this domain. So with those brief introductory remarks, I'm going to sit down now, and then I'll start with you to give me your reflections from a DBSA perspective. How are you leveraging the idea of bringing in more institutional investor capital into what you do in Africa? Over to you.
Okay. Thank you, Leslie, for the opportunity to be here, and also greetings to fellow panel members. You know, as we, are having conversations at COP, the conversation is capital mobilization, capital mobilization, capital mobilization. But the other side, a critical side of that, is the asset building element. And that is the common topic that is being held around issues around project preparation. Because just as much as we mobilize capital, it's going to be critical that we also have investable projects. And that is what, the private sector is always looking for, an enabling environment. Now, Leslie, we have seen successes that are there when you have, as countries with deep capital markets, with policy and regulation certainty. Where those elements exist, private sector funds generally are readily available. We have seen that in the South African context. We released a report on private, our Presidential Climate Commission released a report last week looking at climate finance across the country. And what was interesting about climate investment from that report is that more than 80% of funding came from the private sector. And that is a very, very strong, powerful message that actually indicates those key areas that countries need to get right to be able to mobilize funding. And South Africa has successfully done that in the energy space. But what enabled that was the role of the DBSA and the role of government in actually creating this enabling environment. For this to happen at scale, it is important that we do not look at projects on a project by project basis, but we have a programmatic approach. We saw the success of that with the REAP program. We have an excellent climate finance team within DBSA that has actually created various programs to actually enable private sector funding. The second thing was it's the embedded generation investment program that was created by the team, and that program is actually to then drive energy self-generation by entities, and that program triggered the flow of concessional funding into the program. When you have concessional funding, you have an opportunity to blend, from a project perspective, then you pass on that benefit to the private sector as well, to actually bring down the cost of funds. So those are the structures that we have put in place. Now we have recently developed our water program. We are now dealing with the concept of actually having water as an asset class, and the opportunity to have this water reuse program to also mobilize climate finance. We have secured, I think, to the tune of $235 million US. 35 million of that is going to go to project preparation. Not mobilizing just for projects, but also saying, okay, how am I going to ensure that I'm a project, factory for this program? And that's when you have the project preparation funds to then close, that gap of making sure that the projects are there's a de-risking element to get to bankability stage. So that's the mechanism that we have used, a programmatic approach to investment in making available project preparation funds. And I'm sure my other colleagues will touch on various aspects. The last thing that I want to touch on, Leslie, is we have also seen that with fiscal constraints, then comes the opportunity to then say, how do we develop guarantee structures for the private sector? We are currently, as DBSA, looking at a solution of actually, developing an entity that will actually provide that, necessary guarantee for the private sector that will then, put less pressure on the fiscus, but also provide the necessary credit reps for the private sector. Thank you.
Thank you very much, Boitumelo. Let me move over to you, Erik. Maybe you could give us a flavor of what some of the initiatives and the thinking and your own thoughts around the remaining barriers to overcome to ensure that we can mobilize and crowd in more private sector capital, and maybe zone in on what AIB is doing in this domain. Have you set specific new targets for private capital mobilization? Have that been institutionalized in the structures of the AIB? Keen to hear your perspective.
Well, thank you, and thank you for inviting me to this very important discussion. So, I obviously agree with what was just said about what enables private capital. Obviously, is there are things around the business environment. It's about obviously macro issues. It's about, very importantly, when you're working with infrastructure, it's about policy risk and stability of policy over time. All those things are extremely important to the private sector. And as an MDB, obviously we have a role also in helping to manage these kind of risks. So what we are a little bit different from some of the other MDBs in that we have both the private sector and the public sector under the same roof. So not like IFC in the World Bank. And our objective is by 2030 that we will 50-50. So that's the sort of objective that we are working towards. I think we can talk about this in general, we can talk about it specifically when it comes to climate, but my sense is that most of the things that helps you mobilize private capital in general also applies to climate. I mean, there are probably a bit more concession resources available, and there should be, because there are some real market failures when it comes to climate. But what we have tried to do is we work a lot with, particularly in the beginning, as you can imagine, we are a very new institution, so we are still building our capacity. So we do quite a lot through funds. So we identify funds that focus on specific topics. So climate could be also water. It could be connectivity. So the idea would be that this particular fund manager has a strong capacity to assess investments in that space. We have worked also on something that we have found very promising, and you alluded to it in your opening remark, bringing institutional capital. So here we have talked mostly about private sector capital, but institutional capital is quite different, and we know to get institutional capital into infrastructure is quite, particularly in emerging and developing countries, is quite challenging. So what we have done, actually, there have been 4 transactions in Asia in this space where so basically what you do, you take infrastructure assets away from the balance sheets of banks, you warehouse them, and then you securitize it and sell off in different tranches. And maybe NDB also has been part of this, but for us this was a very important strategic commitment, and we even took some equity in this vehicle just to signal that we were a long-term partner. So we have done 3 such transactions now in Singapore, and we're working on another one that's more or less complete in Hong Kong. So I think that's another way. So what this allows is for institutional investors to come in and pick different tranches, whether you want to have a sustainability tranche or a tranche that's about decommissioning fossil fuels, whatever you are looking for, and what kind of returns you are looking for. So these are just some of the things that we are doing to try to get new sources of capital into emerging and developing countries.
Thank you very much, Erik. I wonder if I could move on to you, Sean. I mean, as you engage with industry in general, what do you see as some of the principal barriers that they perceive are the obstacles and hindrances for them to deploy some of their capital into sustainable infrastructure, sustainable investments in general? As you know, on the ESG side, since at least COP26, since Glasgow, many institutions now have dedicated portfolios, whether it be your big institutions, your BlackRocks, Amundis, they have dedicated portfolios focused on, and they have difficulty to deploy this capital, often for lack of projects and all kinds of constraints. But what do you hear as you engage with industry players?
Well, clearly from emerging markets, given where our largest pools of capital are, in Japan and the US and Europe, etc., there's an asset allocation problem. We have a constant running up against the barriers of tiny allocations to emerging markets. Now, let's not get into the reason why. Let's just say it's a block. It's clearly a block. From a climate perspective, it's a worry. We know the reasons why. 70% of most investment in infrastructure in the next 30 years is going to be in emerging markets, not in rich countries. And it's got to be clean and green. So we kind of need that appetite. In a session I was doing the India Pavilion today, they were talking about how 70% of the capital required to green India, or for India's infrastructure, I should say, can be raised locally, but only 70%. They need that extra 30% internationally to be able to make the numbers work, etc. So this is one significant problem. Some things are changing. We do have increased appetite now in the area I work in, fixed income, for domestic currency denominated debt in the major currencies. maybe African currency is a different problem, but we have rand, we have rupee, we have rupiah, which is growing at high level, more NABFID level or DBSA level rather than corporate level. But nevertheless, that is a change. That is the last 5 or 6 years. We've got a lot of zero rating of countries going on at the moment. Again, not so much in Africa, but certainly in Asia. So the investors are happy to take that risk because they don't see that as a real risk anymore, despite the absurdly low credit rating that India has, for example, given the fact that it's India. So those kinds of challenges, there's scope to change it, but to get the river flowing, at least to start it flowing, is not about convincing people to change. That's a long process, and the asset allocation consultants are a pain in the arse at the moment, I have to say, on this question. It's about getting debt to people in a risk yield format that they are comfortable with and they can easily swap in and out of portfolios. We talked to this question earlier. I've got to find out what went on with the African Finance Facility debt program in terms of green. But typically, if we can get USD or Euro debt at a reasonable scale, or in some currencies, domestic debt at high rating level, we can place it. It can happen. And so that's starting things going. Now, what we really need, of course, and this is where the instruments come in, is risk mitigation and crowding in work done by development banks. Fundamentally, Leslie, we need you to fix this problem. Well, okay, you and everyone else. And what do we mean here? Well, from my perspective of the investors who are concerned in climate-related portfolios, which is growing, and the green bond market, as you know, has gone from $2 billion to $4 trillion now outstanding in the last 10 years. And BlackRock says it's the most successful ESG marketing tool they've ever had. They don't use the term ESG at all anymore, but they're still saying green bonds. So there's demand there, subject to risk yield, of course. I have to come back to that particular point. We need more of that. We need to expand the conception of what's involved. That's transition bonds. The Japanese government in February will issue a $10 billion climate transition bond, which will kickstart this race going globally. We need resilience bonds for emerging markets, especially. We need an understanding amongst investors. If you're going to invest, really look at the resilience side, not the mitigation side. We've got the rules, we've got the mandates beginning amongst DFIs. Above all, we need blending. Our leverage ratios are crap. We need to be seeing 5 to 1 for the ADB, for the AIB, for the EBRD. We're nowhere near that. We're way, way below that at the moment. And the question is, how do we get there? We have investors who will come in beside you if they feel like you're holding the hand. So that's an opportunity for us at the moment. So I think, if you think in those terms, we could do a lot very quickly. And I think with the announcements we're seeing from the MDB community at this COP, I'm very optimistic we will do a lot in the coming year, all of which will mean that river will start flowing. And then once it flows, once people get comfortable with it and understand risk, then we can ease off a bit.
Thank you very much, Sean. Sanjeev, I wonder if I could move over to you. Africa is a continent where, the development agenda is most acute, if you like, and you have a broad footprint as the Africa Finance Corporation. We also know, Boitumelo referred earlier on to the need to scale blended finance. But with underdeveloped markets in Africa, underdeveloped financial markets, those are the markets where there's least appetite for investors to step into. So from your perspective, what do you see as the issues unique to the African continent, if you like? Because also I was reminded in the session where I spoke this morning, that the World Bank came up with a report last year suggesting that when you look at the demography of poverty, the African continent is where, I think in 2035, they say 60% of those classified extremely poor will be located on the African continent. We will fail if we don't succeed in Africa with respect to the development and the climate agenda. So through an AFC lens, how do you look at this issue of mobilizing private sector capital for the continent?
Yeah, so, good evening, everybody. And thanks, Leslie, for the question. I think, I'm in a bit of a fortunate position because I represent an organization which, call it a miracle or call it an inspired faith or call it an accident, just got created a decade and a half back as a multilateral institution, but from day one being a public-private partnership. So it's a contradiction in every sense of the word, as I try to explain the genesis of AFC. For some strange reason, African governments got together with the African private sector and said, let's build an institution with private sector leading the way. So our charter actually says that our shareholding will always, in aggregate, be private sector majority and public sector minority, right? And somehow, somewhere, the visionaries, and I wasn't one of them, so I can't take credit for it, got it right, because accidentally we realized that we enjoyed the public sector's government, sovereign, preferred creditor, immunities, privileges kind of support that MDBs do, but we also from day one had a private sector agenda to try and make money for our shareholders, right? So to that extent, Leslie, this idea of how to mobilize private sector capital to work for the continent has never really been a new issue in our lives, because that's how we were created, right? But very quickly we found out that if we are going to be successful, if we are going to be masters of our own destiny, if we are not going to be tossed around by global external factors, which very often affects us disproportionately, we got to have a methodology that works for us. And I'm highlighting it because that in itself provides some idea to you how we therefore generate private sector capital more than over and above what we already have. Is we have a very large focus on project development. We decided a long time back that if we cannot ourselves, using the scarce capital that exists in Africa, but it does exist, if we cannot develop and de-risk projects in Africa, private sector capital, both domestic and non-African, will never come. So that was the starting point for us to say we want to control our own destiny by developing projects that we believe are financially viable, which we ourselves are then happy to lend to. And that then created a succession of projects, Leslie. And I'm not saying that those are the only projects we invested. We also invested in other people's projects. But fundamentally, that was the core, where we created a succession of projects across the energy sector, across the transportation sector, across the industrial sector, where we basically spend the money, spend the time, de-risk the project, and we brought in private capital. As a matter of fact, I was in a meeting with one of the Minister of Finance of Egypt this morning, and he and I were sharing a statistic because Egypt invested in us recently. And I was just telling him that for every dollar of African capital that I get, I leverage 3 times that in my institution. And for every dollar I invest from my institution, I get 4 times that money from global capital to come in. So for every dollar, therefore, I raise in Africa, I get 16 times pounds for my buck, right? So that's how I've been mobilizing capital. Very quickly, Leslie, in the recent past, and I want to highlight this because it's important, because we talk over the word blended finance, is that we also realize that we are rated A3, which is a remarkable achievement for us, given our shareholders, but it tells you something about how we operate, is we realize that we could support governments with their own issuances. So we recently guaranteed an Egyptian sovereign issuance, which allowed them to go to the samurai market and effectively raise money at almost 800 bips less than they would have done it by themselves. That's an example of blended solutions. We have also provided first loss covers so that private sector capital can come on top of that at a commercial tranche level. We have also been providing outright guarantees on projects. So all I'm saying, and I was at a dinner with the Franklin Templeton Group CEO yesterday evening, and I was telling her that we want the global capital also to behave that way. The grant money, the concession money, the aid money, can we not roll it all up into some sort of a giant insurance guarantee kind of arrangement, which allows global private sector capital to then come into the continent? So all I'm saying, Leslie, is that it is possible to bring in private sector capital, but the first mile has to be done by us The hard work has to be done by us. And it is possible to bring in blended solutions if there is a will. Which is why I find it very frustrating, and I'll be very honest, when I sit in these forums where the World Bank or the IMF or various of the MDBs talk, and I'm saying, what is it that we are missing here? We are missing the fact that you will never be able to solve the world's problems with public capital. It has to come from the private sector. So what can we do to mobilize it should be the focus, rather than looking for new allocations. Because that's inefficient, and that's never going to be enough. Sorry.
Thank you very much, Sanjeev. Boitumelo, can I ask whether the DBSA have, in a similar way like the AFC, also deployed, made use of guarantees, which, as you know, is one of the most effective instruments for capital mobilization, and yet is one of the most underutilized within the sort of development finance community. And then also, if you can also just make a brief comment on whether both you and Sanjeev has now touched on the importance of quality project development. So we have in Africa a number of funds, Africa 50, we've got AFC, we've got DBSA. Are we collaborating in a systemic way together with these, and you not just have a DBSA project preparation, but it is more sort of coordinated?
Sorry, Leslie. We have used the facilities that are available. We have used MIGA for instance, to advance capital. We also have our export credit risk insurance ECIC cover that we use, especially when we lend outside South Africa. So so those mechanisms we have definitely used as DBSA, and they have proven valuable. Now, on the issue around how we work together, and maybe just to add, and I'll drop this in, Leslie, that we are also in discussions with the MDB around guaranteeing, some of our facilities, so that we can also lower our cost of funds. Going back to what Sanjeev was saying. On the collaboration side, there's various levels at which we collaborate with MDBs and as development finance institutions as well. One flagship collaboration platform that we have is the Africa Investment Forum. That is a platform that we have all partnered in. It's African Development Bank, it's Afri-Exim, it's AFC, it's Islamic Development Bank, and TDB, DBSA as well. And this is a marketplace where transactions are showcased and pledges are made around in investment. We recently held an Africa Investment Forum in Marrakesh, and I think we had more than 4 billion in the 3 days, $4 billion of pledges made towards projects. And that was not, just saying, we're going to offer loans. It actually ranged across different instruments, where some commitments were to prepare projects further, some were to equity, and some were to senior or mezz lends as well. So those platforms are over and above what we do between each other, are there and are available. I think where we really need to be looking at is really looking at what I had touched on earlier on, to then say, how do we actually start creating, those entities similar to infra credit that also, not only address the credit risk elements, but also address the local currency elements as well, because local currency across the continent is an issue. But a much bigger issue is the whole financial architecture that needs to be addressed when it comes to funding in Africa. That has to be, I know that the Africa peer review mechanism actually, released the report around that. The cost of funds on the continent is high. I mean, the continent pays 4 times, 5 times more than developed countries. Yet we are the ones that actually require, more development. If we are going to be meeting, the SDG goals, if we are going to be meeting the net zero goals, the issue around the financial architecture, the perception of risk, and the cost of funds has to be addressed. Thank you.
Thank you very much, Boitumelo. And from AIIB side, Erik, I know you have several partnerships with peer MDBs. You've announced the fund with the World Bank and so on. Are you also looking to expand your toolkit with respect to the financial instruments you deploy to be more successful on this front? Because I think you already have a very high sort of private sector operation target of, I think, 50%. But on private capital mobilization, are you looking to make more use of guarantees, first loss structures?
So first a few things. So I mentioned the use of funds to, in the beginning, that was important, when you had limited capacity in-house. For the same reasons, we very early on co-financed, as you know, a lot of our investments, and we have continued doing that, because in the beginning it was about not having capacity, but actually now it's also still about learning, but it's also about sharing risks and working together. So we are now the largest co-financier of both the World Bank and ADB. And what we also do as part of that is that we are willing to take their standards, their ESG standards and so on, their processes. And I think, or at least from our perspective, we think there should be much more of this. This would really be the system working as a system if we could do this. And you can see, if we go into projects together, and you can start talking about securitization and so on, if you have much more standardization around contracts. So that I think is something that would be quite exciting. We are pushing another aspect of collaboration, which is it's very early days to see whether this will work or not, but this issue that's come up now, several of the speakers have brought up the issue of local currency finance. And of course, when we talk about climate now, so much will have to be, or will be financed in dollars, and in countries that already have very high debt levels, and of course after COVID even higher. I think we run a real risk of building up new exposures. And also just the mere volume of capital that we want to see go into these countries with these, still very poorly developed capital markets. You're going to need a lot of thinking around how to solve the immediate problem of local currency finance, and how then to work together to help develop these countries so that they can better absorb the capital. So what we are proposing is to work together. So we would go together, several MDBs and maybe other DFIs in an individual currency, and form a pool. So the idea is to create an entity that can open pools in several currencies. And for example, just to give you an example, in Bangladesh we have 2 transactions that could be part of something like this, but based on those 2 transactions, we could not justify going in and trying to build our own sort of local currency pool. But if we merged with a few of the other development banks, whether multilateral or some of the other DFIs, if we could work with them, and particularly for the others, they have virtually no resources to develop capacity to deal with local currencies. So if we could pool all this together, that could really change the game. I mean, this is not trivial, because to make different treasuries comfortable with delegating this to an entity takes some doing, but we have a very positive conversation around this. So we just had earlier today a seminar focusing on this together with the IMF and some of our other partners. EBRD is working very closely with us on this, and I think they have probably the most sophisticated local currency development, and so I think that is an area that when we talk about climate and bringing capital into these to these countries, if we can solve that problem, I think we have come a long way.
Thanks very much, Erik. Sean, just I wanted to probe a little bit more and hear from you whether you think there is scope for setting up new platforms like what the IFC has done with MCPP, which is a managed co-lending portfolio program where they crowd in. So they had Amundi and some big asset managers co-invest alongside them. Do you see, if you look into the future, the creation of more climate-focused funds like that, and we as development banks could anchor those funds? I mean, do you, as you interact with pension funds, sovereign wealth funds, and the institutional investor community, do you see that as a potential next iteration going forward?
The logical development of the discussion around blended finance is that we start institutionalizing some of that efficient use of balance sheets into a bunch of vehicles that can pursue it. And we've seen a modest proliferation of these vehicles over the last few years, whether that be the IFC Ego Fund, which is, by the way, 70% development bank money, EIB and the likes, and IFC, or whether it be the ADB's ASEAN Guaranteed Catalytic Green Facility, I should say it's called, which is using donor money to provide technical assistance, and credit guarantees, and getting some direct investment, and so on and so on. There's a few nice models now that have popped up, and I still remember the launch of the paper from ADB at the OECD some 10 years ago when it all was new, but it's no longer new. There are many examples. So the answer is absolutely yes. Does it need to be that way? I don't know. That's kind of your question more than mine. It seems to be a useful political way to solve the problem for many banks to set up a special facility and then to send it off, which is not a bad idea in the sense that your fund is a facility that's been set off to do stuff and is pioneering, developing stuff and so on. That's actually not a bad idea. I do really want to, I'm really interested in Erik's point about collaboration, because that seems to me the only way we can solve some rather wicked problems that we have at the moment. Currency risk is the big one, right? We've got to have pools to support this. We're not going to be able to do it very easily in an individual bank. So the collaboration amongst MDBs and DFIs can take many forms. There's platforms that some DFIs will just set up. There is collaborative platforms, multiple DFIs. There are like currency pools or risk facilities. There's absolutely the vehicles that are joint public and private, noting that MDBs have a high trust factor in the private sector as a hand-holding due diligence institutions when private sector investors don't have that. So there's certainly a lot to be done in that area, I suspect, although maybe the African finance will just solve the whole problem for us in Africa, I don't know. There's so many ways we can do this blended finance stuff. The key thing is the collaboration, and I do think the point about collaboration is way beyond collaboration amongst MDBs. That's a starting point. You know, I've been speaking to Aviva, who would like to work more closely with some MDBs to help them get the deal flow. Green deal flow. They're all interested in green deal flows nowadays. So how do we generate the deal flow where they don't have to do the work? Someone else does the work and they can just invest alongside, knowing that someone else is making sure the T's are crossed and the I's are dotted. That's actually gold dust in this area of frontier markets, in this area of getting people out of their comfort zones in Scandinavia or Tokyo into other areas. And so, yeah, there's lots of ways of doing platforms and facilities. It's absolutely what we need to do more of.
Sean, for that. And I wonder, Sanjeev, if I could, again, and I'll ask all the other panelists to think about this question at the same time. In about 10, 12 days' time, McKinsey will release a report. They just gave a snapshot this morning about this, which is really about on this very topic of unlocking greater flows of private sector capital. And one of their ideas is the creation of dedicated climate finance, new financial institutions. Essentially, the argument goes, and there's lots of more deep analytical rationale that underpins the idea that this is not all MDBs do. At the moment, as you know, New Development Bank have a 40% target on climate finance, AIIB already at 50%, EBRD 50%, and so on. We do other things as well, because the developmental agenda is much broader than climate specific. But what do you think about this concept of setting up new climate finance focused institutions led by private, not anchored by development banks, because this is the McKinsey rationale, but that's what we understood this morning because we were both there. Do you think, like, let's take Africa, given that the development banks have our own objective constraints, do you think that the creation of new dedicated institutions that only have a climate agenda, focused agenda, would be value-adding in the current construct?
Well, Leslie, you're obviously setting the cat among the pigeons of some sort by asking that question. And I love that question because, honestly, and this is as humble as you will probably see me when I say this, that, you know, on the African continent, where we are dealing with, as we know, some very fundamental development challenges, right? Fundamental healthcare challenges, fundamental energy crisis, infrastructure non-existent. We are very troubled, if that's the right word, when we hear an agenda globally which veers away from the word development to the word climate, right? Because to us, the climate agenda is intricately and inextricably linked to the development agenda. And the tongue-in-cheek comment I kind of make is, I was saying something this afternoon, I said that, you know, today's climate crisis is a function of industrialization and its ramifications. Because pollution and emission has no borders, Africa is disproportionately affected. But because of lack of development, Leslie, we are worsening it. A good example is we are cutting trees to put firewood to cook food, while we are being told, don't develop your gas resources. I mean, till the Ukraine war happened, gas was a no-no. Remember that, right? So, you know, some of the things I kind of like to joke about is that at least we have one half of the problem the world has, because the world has the emission problem to deal with and the effect of climate to deal with. We only have the effect of climate to deal with because we don't have an emission problem to deal with, right? But that's a funny way of highlighting the fact, the question you asked me, Leslie, that we don't know which way to go. Because for us, climate, as I said, is a subset of the development agenda, right? And nowhere in any history can it be shown, or any model that can prove that you will have climate as a priority and have development as a lower priority. It doesn't work like that, right? So our problem is, how do we balance that aggression, if that's the right way to put it, that we will only do climate and anything else we will not touch, be balanced out, right? We also have another problem, Leslie, and this is something real, that today's geopolitics has reached a form and shape that, you know, we have a saying in the African continent that when elephants fight, the grass suffers, right? And we're suffering because when I go to a greater power for funding, I am told you will not take money from the other greater power, right? And as a matter of fact, we signed a deal for an extension of a facility with a great power of the world. And I got a call from the government senior government official of the other great power saying, what have you done? That's my other problem, right? That we are being tossed around. The good news is that increasingly the world is no longer bipolar. It's becoming multipolar. And there are pockets of capital coming from different regions, this region being one, India being another, where the development agenda, the need to work together, the need to, make sure that Africa is part of the solution that the world seeks, means that Africa has solutions. Has options. I'll end by just saying this, therefore, because you asked me a very specific question, that I just want the world to understand that when it comes to diversifying its supply chains, which is a priority, when it comes to having more security over food supply, which is a priority, when it comes to access over energy sources, which is a priority, when it comes to access to critical minerals, which is a priority, when it comes to having new markets, which is a priority, and when it comes to managing immigration, which is a priority, Africa is the solution. So look at Africa holistically, because if you invest on the continent, you will solve your own problems. And that's how I want the narrative to go. And if I can shape it, then climate will be looked after, because climate, as you know, Leslie, you come from South Africa. We are affected by climate changes, much more than people who talk about it, right? So that's how I would end my answer to you.
I'll just ask the other panelists also to give some reflections on this idea of whether there will be significant value add from creating dedicated climate finance private institutions who then can work with us as development finance institutions. What do you think, Boitumelo?
Leslie, I was just, reflecting on what Sanjeev, what came to mind when you said that, I just thought, oh my goodness, good luck. It's a myopic way of looking at what we are faced with, especially from a African continent perspective. We are the least emitters in the world, and we are the most impacted by the climate crisis. You cannot look at climate, and I agree with what he has, you cannot look at it independent of what we need to achieve from an SDG perspective. We're still in a continent where more than 600 million people do not have access to energy. We are in a continent where there is going to be more youth in the next 20, 30 years. We are in a continent where the southern part contains the minerals that are required for the green growth economy. We are on a continent full of resources and opportunities. This, when you look at the climate, agenda and us achieving SDGs, this is an opportunity to actually, for the two to converge. The climate agenda and the SDG agenda has to converge for us to achieve the development imperatives that are much required. If you focus on the one, you are most likely to undermine the other. But when you focus on both, you will reach optimal decision-making, optimal implementation of projects that are necessary to drive growth, development across the continent. So a single view, Leslie, I don't see that really achieving anything. Thanks.
Eric, any reflections on that question? Or do you think our existing institutions ought to be, modified, in various respects, our business models sort of changed, and little appetite for creating new? What is your view?
Now, first of all, I think the basic point is made here. I think is absolutely right. I mean, as was said, Africa has stronger interest in getting this right than any, because of the impact of climate. So and because it is more impacted by climate. And I think to me this is the challenge. How do we do this? And you know, it's not like we cannot compromise either on, you know, there's only so much carbon budget left. So, you know, who is going to get to use that? And how is it going to be used? You know, that is, you know, a really fundamental question. So, and we know that, yes, emerging countries elsewhere are now quite important emitters, and you know, Africa, if what we want to see happen in Africa, this will also become an issue in Africa, and we need to find the way so that, you know, we don't pass by tipping points that will completely make the situation catastrophic in Africa. So this is, you know, how we solve this is going to be absolutely critical. Just on a very practical note, starting new institutions, and I think we can say, both you and I can say something about that, and you know, it is very costly. It takes a long time to set them up. We don't have a lot of time here, so I think repurposing the existing institutions, making them more effective, you know, working as a system, using the fact that we have, you know, more or less the same shareholders in different constellations. I mean, you are a little bit different, but still, you know, it's G20 does play a very important role in your shareholdings as well. So if we can get that right and focusing on that issue, you know, the existing institutions, that is to me the solution. I'm not against, you know, creating one or more, but that's not going to be the solution because it's going to take too long to deliver.
And as we move towards the sort of final question that I will pose to all of you, you can start thinking. I'll start with Sean on this one. Sean, if you can also comment on this one about the creation of a special focused climate finance institution. But in my final question will you, we've been here now for a few days. If there's one insight that specifically will stand out for you from your experience having been here at COP28, what would that be? In other words, how are we, when we move forward and we take stock of what we have achieved at this COP, is there an idea around this private capital mobilization space or any other that you think really will sort of resonate or will stand out there as an important sort of development from the deliberations here in Dubai?
Well, I'm going to comment a little bit on this and say there are two issues here. One is the concept of development, and the other one is the institutions that deliver. On the concept of development, you're right. It is about, you know, they're not separate things. For me, the resilience agenda is the bridge. Because we now have to prepare for drastic changes in the climate, we have to make sure our societies can deal with that. It's not just physical resilience, that's part of it, but it's also social and economic. And you know, if a society is going to be buffeted every few years by drought or a storm or some other kind of ghastly experience like a pandemic, which is predictably frequent, then we need them to be better able to bounce back. And what does that mean? Well, of course it means education, it means educated work. Of course it means a health system that works. And of course it means wealth. Because, you know, the US ain't going to come in and on a charger, or China's not going to come in on a charger when they're dealing with their own pandemics, their own crisis. So development is actually absolutely central to the response of climate, given where we've got with climate, is what I would say. But there are some arguments. I will disagree with you on gas. We'll have the argument outside on the corridor. But, you know, there are still some arguments about what are the right investments to be made on the greening side, and that infects institutions. So the question about the institutions we need, I think, is related to the market. In some markets, frankly, it's a lot easier to set up a purpose-built institution that will chase a topic and get it going. In the UK, the Green Investment Bank was set up in 2010. It was very useful to pioneer financing for offshore wind and help drive down the cost of offshore wind. And it probably wouldn't have happened for the mainstream institutions because they weren't across it. They're saying, yeah, it's really important, I'll get to it eventually. Like some of your institutions, your peers are around the world at the moment. So we've got horses for courses. There'll be some cases relevant, but of course the ideal is to do what we've managed to do in the European Investment Bank. 50% of all lending has got to be climate. The other 50% has to be resilient and can't contradict climate while you're at it. Now, if we can marry development like the IFC is doing at the moment, and you're trying to do at NDB, I think we've got a formula here for the transformation of major institutions. But we do still have a lot of confusion about what it is that we really have to do, given the storm that's coming down at us. And that's, at that point, sometimes special purpose institutions can work. But look, one last, your wrap-up comment. We've had a win this year. You know, when I first started making speeches at COP, I used to talk about how it's got to stop being a COP of climate ministers. That's just a waste of time. It's got to be a COP of finance ministers. Well, this is what we have now. I've been in a number of sessions with finance ministers. This is exciting. Now, it's not quite there fully, but absolutely, finance is front and centre of this particular COP. I'm going to call that a win. We haven't solved things yet, but at least we've made it mainstream, for God's sake. It's taken us 30 years to get here, but we're there. Clarity about what to do is still needed. Witness some of the arguments between different countries about what's got to be done. We still haven't adequately channeled the IPCC and the science into finance and into government policy. There's work still to be done. Even the AIIB, I'm still having arguments with Chairman Jin about gas. So that's another story about it. But he did announce at our conference coal was out, and that was an extraordinary win in the journey the AIIB has been on to better meet, if you like, the future demands of its member countries. Making sure that everything we do is future fit is the game now. Clarity about what that means will hopefully emerge over the next year or two quite quickly. But at least we're now talking about finance.
Thank you very much, Sean. Sanjeev, anything that stands out for you from this COP, ideas you want to sort of take forward into AFC's agenda going forward?
Yeah, so I don't know whether I'm imagining it or I was just in a different set of meetings to people who may be a little more cynical. But I have to admit that I am actually feeling better in this COP than I've ever felt. And I don't know whether feelings count for anything. I feel that the whole conversations around development, climate being a subset of that, gas being a transition fuel, you can buy the drink, we can argue later on that. The sort of challenges around how do we monetize Africa's forests so that the carbon credits that the world needs can fund Africa. These conversations are happening, Leslie. And it's not only happening, there is ready ears and minds to hear it, right? So to me, I feel much better this time around than I even felt last time around, right? The only thing that I wish could come into the agenda, which I know will never do per se, is that for the developing world, particularly a part of the developing world that I come from, where regrettably, for various reasons, we are very dependent, much more dependent than other developing countries in terms of global capital. I really wish that the flip-flopping around key agendas at the global stage stops. I really feel that just like civil aviation rules don't change just because countries are fighting, so should financial decisions not change because geopolitical movements are different. And that would help us tremendously. That would be my wish.
I'll ask Boitumelo to end. Erik, anything that sort of resonates with you from the last couple of days that you are excited about as you go into 2024 with AIIB?
I mean, I just want to pick up something that you said before about, when the elephants dance. And so I do feel that we are here in a slight bubble. I mean, we have some really major conflicts going on. We have a geopolitics not being very supportive of what we are trying to do. So Yes, I agree. I feel better than in Sharm. But and that can be about Sharm also. but no, I do feel that there is there's more accumulation, more sense of progress, and I think the loss and damage fund, you know, I see now, you know, how, for example, I'm very involved at the subnational level now, that everyone is starting to think, how can we use this? Where can this come in? You know, it does create some kind of hopeful momentum that can hopefully sustain, despite all this very troubling external environment. We can still continue working at different levels and translating these kind of vague ideas into really concrete action.
Thank you very much. And Boitumelo, over to you. A final comment on what you take away from this?
I think it's the whole discussions around the loss and damage funds. But hopefully, you know, we're still dealing with the initial pledges having to flow from the global south to, from the global north to the global south. So we will see how that you know, follows through. But I think what is critical, Leslie, is the alignment and the collaborations that are happening at the MDB and PDB level. You know, that is a very powerful alignment around, you know, development and climate, you know, being seen as actually, you know, interlinked. And for me, that is one thing I'm taking out, and the alignment around building climate resilient, sustainable cities. You know, we are aligning on the importance of that, especially within the African context as well. So that's what I'm taking with me. Thanks.
Thank you very much. Maybe just a final comment from my side. I mean, I had the opportunity to be a fly on the wall yesterday when the heads of MDBs met, and I must say that, you know, in all of the last 8 years of attending World Bank, IMF annual meetings, spring meetings, this time around, I think there is clearly a sense that there's a very definitive roadmap as identified in the MDB reform agenda. We have got fresh leadership in the form of, you know, specifically at the World Bank, which has brought fresh impetus and new ideas and energy and momentum. And I think that just even the fact that, you know, MDB heads who used to meet twice a year and sometimes at Davos like 3 times a year, they have 6 meetings scheduled for 2024. They're having a retreat, you know, which means that the idea of MDBs working at a system and solving these more systemic issues together is much more real and concrete. So I'm leaving here much more optimistic. I mean, I share the feeling, Fry, that others have already highlighted, that we're in a much better space now. There's still a number of unresolved issues, but a clearer roadmap, and as Ashona said, finance is right at the center of the agenda. So with that, I'd like to close off and again apologize for the late start due to the technology challenge we had, but enjoy the rest of your evenings, and we'll see you all tomorrow. Thank you.